want to bring Mohammed El-Erian into this conversation. He is the co-CEO, co-chief investment officer at PIMCO, largest fixed income asset manager in the world. Mohammed, we welcome you to the program. Thank you for giving us a slice of your afternoon. If I could, I'd like to address this with you starting as large as possible. If you look at the problem, on the street level, people took on too much debt. On the institutional level, banks and insurance companies assumed way more risk than they could actually afford to take, and the U.S. government has already borrowed tons and tons, trillions upon trillions of dollars, and now we're just adding that debt up the chain. That's one problem. Number two, we've got the obvious aspect of continuing foreclosures and the housing market in distress. And then number three, we have coming job losses in the auto industry, mortgage finance, Wall Street, etc. As you look at those macro factors, those systemic aspects, how do you go about trying to form a view as to what you think this economy will look like over the next 12 to 24 months?
You know, Dylan, I start from where you just ended, which is that there was failure, and there is structural failure at every level, at the level of the investor, at the level of firms, in terms of the risk management, rating agencies, governments, and the multilateral level. When you get such big structural weaknesses, and then you get a global deleveraging process on top, you're going to create a lot of damage in the system. And that damage is going to spill over onto the real economy. That's where we are today. Now, there's certain aspects that you all have been talking about. Overshoots are inevitable in these circumstances. So always look for the high-quality name that has been damaged by the overall environment but is likely to recover. Second, focus on the capital structure. You know, it's not enough to like a company. What bit of the capital structure do you like? And the reality is certain companies, no matter how good, are going to dilute the equity holders further and are going to get support at the level of the bonds. So be very conscious of the capital structure. And the final point I would make is don't expect the recovery to be instantaneous. It's going to take time. Make sure that you have enough liquidity to manage it. But we are starting to form a bottom in this market, and there's starting to be some good value there. And just a matter of being disciplined and being very selective.
Mohammed, it's Guy. You're a stud for coming on. Are you encouraged by what you're seeing in the credit markets at all?
Yeah, you know, today the bit that wasn't talked about at all is there's a process of healing going on. The CP market is coming back. The repo market is coming back. The money market is coming back. That is the plumbing of the system. Without it, nothing else will come back. So we are seeing it come back. That process will be turbocharged next week when the government facilities, including the CPFF, come into execution. So far, we've just had announcements. Now we're going to have actual implementation. So I am encouraged that the plumbing is coming back, that we're starting to unclog the system slowly. And that was a positive part of today that, of course, got totally overwhelmed, but what else was going on?
Yeah, how do you assess the potential, as we heal the credit market and heal from the disjuncture, the event, if you will, and now await the real economic impact, the layoffs, the foreclosures, all the things that we now will wait for? How do you even begin to calculate the severity of what you think that will be?
Well, first, we have to recognize that the healing is coming too late for certain entities. So we're going to hear about hedge funds continuing to delever and some of them closing down. Second, there's going to be a handoff on what we worry about, from deleveraging to economic issues. So there you're going to be protected in terms of the impact of what is likely to be lower savings, lower investment, and lower trade. Thirdly, take advantage of what we know. We know that certain sectors and certain capital structure are getting support because they're systemically important. So focus on high-quality names, and that will help navigate the remaining mines on the deleveraging and the economic weakness.
Yeah, hey, Mohammed, it's Tim. Fewer as well versed on foreign and emerging debt markets than you. Where around the world where we're supplying IMF aid and where we're having blow-ups and fiscal crises are you most concerned? And can you characterize the problem that they're all facing right now?
Yeah, all of them are facing a simple issue, which is when the world is deleveraging, distressed sellers sell everything. And if they happen to own emerging market debt, they'll sell that too. And in fact, yesterday was the worst day for emerging market debt, okay, even in the last 7 years, even worse than after September 11th. So yesterday we started to see in that segment, in the peripherals, a deleveraging process that, of course, continued overnight in the equity markets and in the currency markets. So some of the sell-offs are warranted. So there are certain countries in Central Europe and Eastern Europe that are not going to be able to navigate this new world. But there are others that have massive reserves, are waiting to start buying back their own debt, and are net creditors. So you're going to see differentiation starting to come in that segment too.
I got to wrap this up, Mohammed, but I'm going to ask you the same question that I asked Karen a few moments ago. In the scope of your degree of optimism or pessimism about financial markets and the way the crisis is being handled this Friday as compared to the preceding 6 or 7 Fridays, however far into this we are, how do you feel this evening?
I'll answer the same way she did. I feel more optimistic than I have in the past because we're starting to see the final stages of the deleveraging, and we're starting to see policy go from announcement to implementation. So we are in a better place today than we've been for a while, and we just have to navigate carefully what lies ahead.
All right. We appreciate you taking the time to share your mind and your thoughts, not only with us, but everybody that watches this program. Enjoy the weekend. We hope to have you back again soon. I
got some answers for you.
What do you got?
Well, okay, free pork. 2 times, not 1 time. But 2 times. 2 times cash flow.
Okay.
Okay, now I realize cash flow will go down. I get it. Okay, and you say, all right, they have debt. But when you look at their debt maturity, they have the biggest slug of their debt does not come due to 2015. That is an eternity from now. So at 2 times cash flow, maybe it's overdone.
I like it. Well, how do you feel about that?
I take her, I take Freeport, I take everybody.
RTI in the titanium business.
Okay.
1 time cash flow, net cash. I mean, there are even companies that trade at negative value, where the cash is worth more than the entire enterprise value of the company.
We are back. Thank you very much. We're going to even talk to Pete and El-Erian when we come back.